Welcome all to this event, the Political and Economic Outlook. For those of you who don't know me, my name is Ted Helms. I'm the Executive Director of the Chamber. I'd like to recognize our Council General here in New York, Ambassador Ennio Cordero. Just as way of background, I myself, for many years I was with Petrobras and now the Chamber, but I've been coming here for 20 years. It really is one of the premier events of the Chamber. We do it every 6 months, and of course, for those who know Brazil, you really need to have a reset every 6 months to figure out what's going on. So for that reason, that's very appropriate. We always have a great panel. Special thanks to Paulo Vieira de Cunha, who is really the brains and knows everybody and can bring together a crowd and organize and orchestrate, if you will, a very interesting discussion.
Good morning. It's a pleasure to be here for another edition of The Outlook. I would like to thank Deborah Clinton and Mauricio in particular for hosting this event, and especially our distinguished panelists for coming today. The economic background is finally, as Mauricio hinted, good. You know, we've had the Social Security. I mean, it's still missing a leg, but that's kind of a foregone conclusion. There is a trade agreement that could be a very important, although it takes 20 years to be implemented, but it is a mark. The new infrastructure investment program, including energy as well, is off to a very successful start, and it could be an important engine for attracting new investment, both domestic and foreign. We have the BNDES being restructured and reconsidered in its function. We are seeing some of the positive impact of last year's labor reform. We have a continued commitment to the fiscal rules. We have surprisingly good microeconomic reforms, particularly on the financial sector. We are discussing the tax reform, this time perhaps more seriously than for the last 30 years that it's been discussed. And on the macro front, importantly, we have stable and lower inflation, a still healthy balance of payments, and a significant drop in country risk. And finally, perhaps best of all, we have a responsible and active commitment of the Congress willing to lead where the executive has failed. So a real kind of encouraging set of good news, but for all of that, as you probably know, growth is stagnant. GDP continues to falter. The fiscal crisis of the states has caused a really abysmal loss in the quality of public services. Unemployment remains above 12%, and the rate of investment in new machines and equipment is hardly above the rate of depreciation. So not really any growth in potential GDP. And there is today a recognition that low growth in Brazil is structural, restrained by low productivity, not only in the years of the recession of 2015 to 2017, but really for decades. The expectations about the new administration are mixed. The executive seems to function in continued disarray. It gets things through Congress, but fails to inspire confidence. And indicators of economic uncertainty and confidence have dropped and went really seriously south in the second quarter of this year and have not recovered. Despite the good news, consumers and investors in particular remain apprehensive. And no doubt this is in part due to the politics. The president's popularity has fallen, and he seems to be someone that can govern only through his popularity.
Brazil has one of the weakest fiscal positions on the EM space. Not only the level of the debt, 78.4% of GDP, just released yesterday, but also the path. We have the highest nominal fiscal deficits on the EM space. This was last year, 7.1. This year we forecast some improvement up to 6.1, but it's still a very large nominal deficit. And the second challenge is definitely on the growth outlook, as Paulo mentioned. If we look at the chart, especially since the end of 2013, what we have been seeing in terms of growth outlook is a series of one disappointment after the other disappointment. We expect actually an easing cycle of just 100 base points to 50 base points in the following couple of meetings. And the reason why the shorts should be short in our view is that I'm more confident on the growth pickup. The monetary policy stimulus also, we are starting an easing cycle from the record low interest rate, from interest rate condition that is already stimulative. So that's why also it's important to keep in mind when we compare Brazil with other countries. And the other cyclical point would be in terms of confidence for investments. I think that a lot have been done, especially social security reform. If we look how binary the scenario was with or without the reform, I think that will take some room for us to see a growth pick up, and also on investments, on investment side. So what we are forecasting is that growth will accelerate from a 0% average in the first half of the year to above 2% in the second half of the year. And then going forward, I think that to sustain a sharper growth, we will still need a lot of structural reforms. And what highlights in Brazil is that we have one of the lowest investment ratios in the world, and also a very negative and a very low productivity gain. So that's why structural reforms are so important. The tax reform, when you have the fiscal conditions that we have, it's a tax reform that will not be able to reduce the tax burden. We do not have fiscal space to do that. So, but there's a lot of room to improve the tax system by simplifying the tax system. And if we look at the third line in the chart, in the table, it's just look how many hours it takes to deal with tax in Brazil in comparison with the rest of the world. So normal company in OECD would take like 160 hours per year to deal with their taxes. The rest of Latam 330, and Brazil 1958 hours. And it improved. It was more than 2,000 a couple of years ago. And this is, I think, that's the main challenge that we have. And my outlook here is less constructive than on the cyclical recovery, because if we look right now, we have more than 5 different proposals on the table, meaning we have no consensus. We have one proposal in the lower house, one in the Senate, one that the government will release, one from entrepreneurs, and a complete lack of consensus.
Many people perhaps get confused with the concept of savings. Savings in this case just means that the spending in the future will grow less than it would otherwise. It doesn't mean that you're going to bring the system to a balance or even generate, let alone generate a surplus. It's just the first step. So I try to keep this brief. I only have 2 slides, but basically what I did in this one is just, we're trying to estimate just with pension reform itself, ignoring any other possible fiscal measures to be enacted, what would happen to the primary balance and consequently to debt to GDP. We see there on the chart on the right-hand side with the debt to GDP that we would crash into a wall if pension reform does not pass, right? So we are on the way to avoiding that scenario, and that is great, but again, it doesn't solve it. It's the necessary but not sufficient condition for us to move forward. In fact, actually, the Treasury's own estimate that they published not too long ago say that for us to see debt to GDP back to levels in 2015, back when we still had the investment grade, the primary surplus would have to increased close to 3 percentage points of GDP. This means like a permanent adjustment of 250 billion reais for either in higher revenues, lower expenditures, or a combination of both. And we don't see that happening anytime soon. We do have a very wide output gap, like investments have been depressed for too long. There is some spare capacity there before investments are truly necessary. So we see this first moment of the recovery maybe being led by consumption, which has grown for the last 9 quarters, by the way. And in a second moment, sustained with investments.
I think yeah, there are many stories about credit being weak, and certainly it's true when looking at bank credit data. But I spent some time doing some work on this and realized that actually corporates are borrowing a lot in the bond market, in the beer and the local bond market, and this I think is a very important structural change. We can talk a little bit more about this later eventually. But I think the size of the asset management, the local asset management industry has ballooned. So part of these assets eventually will go in funding Brazilian corporates. Maybe some of them will go abroad, but certainly some will fund local corporates, and this is a very important structural change. But the market is also pricing a very, very sharp increase in interest rates. Not very sharp anymore, but it's pricing cuts, and then as soon as the end of 2020 is pricing very high. So in my opinion, a country that where the inflation forecast is not that far off from the target in 2020, that is trying to reduce the inflation target in the future, and where the market is pricing a very sharp cutting cycle now and then already hikes at the end of the year. I think that one of perhaps is a better strategy to try to cut a little bit less now and keep rates lower for longer.
I mean, we had talked a lot about social security reform and strictly speaking on the fiscal dynamics, but it's fair to say now that when we look at Brazil's rating trajectory going forward, we are shifting to talk about growth, because this is really what will make a difference. And then growth has been, I call it a recovery, so now we need to move from a recovery to growth. The growth of 1% for now will be 3 years, let's say 17, 18, and now 19, is stable, right? It's not really the kind of growth that will change the credit profile, and that's why we put a lot of emphasis on next steps and what will happen with the reform agenda and the structural reforms. If you look at budget flexibility and why social security reform is very important, I think many people in the audience would know that about 90% of Brazil's spending, the government spending, 90% is mandatory, as it's called. It's either interest payments or it's actually not, it doesn't even include interest, that's primary spending. 90% of primary spending is mandatory. And a lot of that, most of it, half of it is social security. So transfers, wages, different benefits, and then on top of that you put interest costs. So there's very limited ability or room for the government to cut spending to achieve its primary, to reach a primary surplus, for example, or to reduce the rate of increase in government debt. So if you compare Brazil to other countries, it's there in the red quadrant over there, and debt is high, so it increased over time from less than 60% to now 77%. But at the same time, interest rate is still very high. But the combination of that reduces really the fiscal space that the country has to invest or apply counter-cyclical policy in a downturn cycle. We talked about that. One of the reasons why growth is weak is also because of the fiscal consolidation that is going on. It's necessary, it has to happen. It's also at the federal level and at the local government level, but the reason the government doesn't have the room to apply fiscal stimulus, for example, except at the very margin, is because of the very limited room for fiscal flexibility. Compared to other countries in the region, for example, with Chile, where we have very low debt and low interest rates, you have room for fiscal policy to be counter-cyclical. This is not the case. This is not the case here, and I think it supplements what others have said about the recovery has been weak.
Bolsonaro lost at least 15 percentage points of popularity since January to April, May. This is huge. This is a lot of people. And who was basically those people? We basically are pulling in a weekly basis the popularity of the president, and those people are basically the middle income, lower class, north and the northeast, and those people are the most affected by unemployment and what we call they lost income. And this is an important aspect about the unemployment here in Brazil today. We figure out that on top of the unemployment rate, there is a lot of people that gave up looking for jobs. They are in the informal sector. Because Bolsonaro lost 15 points, why? First of all, those people didn't vote for the Bolsonaro project. They voted against the PT project, basically. Those are the people that voted for him in the second round. And why did they lose them so fast? Because Bolsonaro was elected without showing to the public opinion what the projects were about. When I ask about people, 1 year from now, how do you feel the economy? 45% in average say they think the economy is going to be worse. 30% think the economy is going to be better. So, and mostly the 30% that thinks it's going to be better are those that support the president, are basically people more educated, more located in the big areas of Brazil. But the deep Brazil is suffering, and they are not that optimistic about the government.
Let's go to the big questions of how do you raise public investment and the quality of investment. Let's start with someone this way back, and this will be our last round.
Okay. I mean, to start with, Brazil does not collect a small amount of government revenue. So, in a way, you could argue, and there is not a lot of room for raising taxes. So, a country with 35%, let's say, tax rate, and relatively that's the size of the revenue that the government collects, it's overtaxed for emerging markets. So, it's not that the government doesn't have the resources to spend on health and education, or you could always have more, right? There's always room for doing more. But if you look at other countries, this is not where the problem is. The fiscal structure issue. It's on the spending side. And part of that is we talked about the lack of inflexibility. You have earmarking for health and education, but the quality of the spending, I don't think people are very happy with. The same time is that when you have the same proportion, it's also earmarked from revenues. You have a certain portion of revenue that must go to health and must go to education. It does not match necessarily the needs of the local government level, and you have governors saying, oh, I have money for health, but I actually need to build schools. Aging changes things. So you have states where you don't need to build schools, but the money you have in the budget is for schools, not for health, even though you have an aging population. So it's completely inefficient. I mean, you cannot budget that way. So when we talk about improving flexibility, it goes to the micro policies or the sectoral policies as well. So something has to be done there. So the spending ceiling actually changed some of that, but still the structure remains the same because now health and education spending grows by inflation, but the same starting point.
We would need to have the government tackling the second largest item in the budget, which is payroll, right? The first one is Social Security. We're sort of trying to deal with that. The next one is payroll. It's not going to be easy, right? Reducing that. There apparently there are some studies on the amount of attrition that could happen in the next 5 to 10 years. People retiring that will not be replaced. I'm not so sure if we're going to find huge gains of efficiency to make up for those retiring not being replaced. But I think a discussion in the next few months and maybe next year we might start to see is reforming the spending cap, as we already heard, in terms of removing public spending from under the cap. It still has to be paid somehow. Like maybe that would mean that debt levels are not going to decline as fast because this will be removed from under the cap. But when thinking about public investment, right, yeah. So it's that doesn't solve it. But if you look at other ways of allowing public investment to recover somehow. Maybe it would be a mix of both, like tackling the payroll, which will take time, and in the meantime, removing it from under the spending.
Very good. I think this was an excellent discussion. I think we learned a tremendous amount today. I would like to thank our panel.